The private credit industry, which spent the last decade marketing itself as the sophisticated investor's secret weapon promising double-digit returns with low volatility by lending directly to companies outside public markets, is experiencing something its promoters insisted was impossible: genuine liquidity crisis combined with a crisis of confidence. Investors who poured over $1,007 trillion into this opaque, largely unregulated corner of finance are now discovering that the promises of easy access to their money were always conditional, that the supposed stability was achieved through accounting gimmicks rather than genuine safety, and that when everyone rushes for the door simultaneously, there may not actually be a door at all. The fourth quarter of 2025 saw withdrawal requests from major business development companies, BDCs, the primary vehicles through which retail investors access private credit, spike by 2,000% compared to the previous quarter, with over $299 billion in redemption demands hitting firms like Blackstone, Ars Management, and Blue Owl Capital. These aren't marginal players. These are the blue-chip names of alternative investing. The firms that spent fortunes on marketing campaigns promising that ordinary investors could finally access the same lucrative lending strategies that university endowments and sovereign wealth funds used to generate consistent returns uncorrelated with stock market volatility. The scale of investor flight tells a story that contradicts everything the industry has claimed about its resilience and appeal. Blackstone's BCRED, the largest non-traded BDC with over $47 billion in assets, faced redemption requests totaling $2.1 billion in a single quarter, representing 4.5% of net assets, more than double the historical norm. Blue Owl Technology Income Corp took the unprecedented step of allowing investors to withdraw 17% of its net assets, worth $85 million, a level of redemptions that should theoretically be impossible in a fund that caps quarterly withdrawals at 5% under normal circumstances. The fact that Blue Owl honored these outsized requests suggests management recognized that refusing would have triggered even greater panic and potentially resulted in legal challenges from investors who believed they had purchased liquid investments. Ars faced redemption requests exceeding 5% of assets, with one particularly large institutional withdrawal contributing to the surge. These numbers matter because non-traded BDCs were explicitly marketed as offering quarterly liquidity, the ability to get your money back every 3 months without the volatility of publicly traded vehicles, and that promise is now being stress-tested in real time with unclear results. The industry's defensive response has followed a predictable playbook, emphasized that funds are still experiencing net positive inflows overall, meaning new money coming in exceeds money going out, highlight strong historical returns, typically citing 10–11% annualized performance, and reassure investors that portfolios are well-positioned with ample liquidity to meet obligations. Blackstone representatives noted BCRED has delivered 10% annualized returns since inception with strong, positive net flows, while emphasizing that investors continue to recognize the premium private credit can offer VUSA's public fixed income. Blue Owl touted its roughly 11% returns and stated the portfolio is well-positioned and with leverage below target, we maintain substantial liquidity for future investments and obligations. These statements are technically accurate but deeply misleading. They obscure the fundamental question of what happens when redemption requests accelerate beyond the industry's capacity to honor them without forced asset sales that would reveal the true market clearing prices of loans currently valued using internal models rather than actual trading. The mechanics of how non-traded BDCs operate reveal why this moment is so dangerous. Unlike publicly traded funds where prices adjust second by second based on supply and demand, non-traded BDs value their holdings using internal assessments and appraisals rather than market transactions. This allows them to maintain stable reported values even when the actual market for the underlying loans is deteriorating, a phenomenon sometimes called shadow defaults, where borrowers receive extensions, modifications, and forbearance that would constitute defaults in public markets but are classified as performing in private markets. Investors are essentially trusting fund managers to honestly report values on illiquid assets where no objective market price exists, creating obvious conflicts of interest since managers collect fees based on assets under management and have every incentive to maintain inflated valuations for as long as possible. The current wave of redemptions is partly driven by sophisticated investors recognizing this valuation gap and deciding to exit before the inevitable repricing occurs. The broader context makes the timing of this withdrawal surge particularly ominous. Private credit fundraising hit records in recent years, with firms raising hundreds of billions as near-zero interest rates made traditional fixed income unattractive, and investors chased yield anywhere they could find it. But that capital raising created its own problem. Firms now hold roughly $50 billion in dry powder committed capital they must deploy into loans at precisely the moment when competition for deals has intensified, credit standards have deteriorated, and the economic cycle appears to be turning. Goldman Sachs analyst noted that if redemption requests stabilize at around 5% of assets, non-traded BDs would experience approximately $45 billion in annual net outflows, forcing managers to either curtail new lending or sell existing positions to meet redemptions. Either option has negative consequences. Reducing new lending shrinks the fee-generating asset base, while selling loans in size would establish market prices likely below the model's valuations, forcing write-downs across the industry. Multiple factors are converging to accelerate the crisis. Federal Reserve rate cuts are reducing the income these floating rate loans generate, directly impacting returns investors receive. Competition from traditional banks, which retreated from middle market lending after 2008, but are now returning as regulations have eased, is compressing the spreads, extra interest, that private credit firms can charge. The much anticipated wave of mergers and acquisitions that would create demand for leveraged buyout financing largely failed to materialize in 2025, leaving firms struggling to deploy capital productively. Regulatory scrutiny has intensified, with the SEC raising concerns about liquidity mismatches, valuation practices, and whether these vehicles are appropriate for retail investors who may not fully understand the risks. High-profile corporate failures in the private credit portfolios have raised questions about underwriting quality that had supposedly been superior to public markets. The State Street Prive EDF case study illuminates the fundamental impossibility of packaging illiquid private assets into daily liquid wrappers. Launched with Apollo Global Management as the private credit source provider, Prive was supposed to democratize access to institutional quality lending. Instead, it has attracted only $45 million in a year when the EDF industry overall raised $1.5 trillion. Its actual private credit allocation hovers between 8-21% depending on who's counting. With the rest in treasuries and public bonds, it charges 0.7% annually despite delivering performance. Barely better than cheap index funds, and it immediately faced SEC scrutiny over liquidity risk management. The fund's structure acknowledges the impossibility of its premise. It caps illiquid holdings at 15% to comply with regulations, meaning it can never be primarily invested in the asset class it markets itself around. This isn't a solution to the liquidity mismatch problem, it's a tacit admission that the problem is unsolvable. What makes the current moment a genuine inflection point rather than routine volatility is that retail investors, the non-institutional client base that firms spent billions recruiting over the past 5 years, are experiencing their first real stress test since COVID. These investors were sold a story about alternative investments providing diversification, steady returns, and professional management previously available only to institutions. They're now discovering that alternative often means opaque, that steady returns were achieved through valuation smoothing rather than actual stability, and that liquidity was never actually guaranteed despite the marketing materials. As one investment advisor noted, when investors are paying private market fees for a large public asset allocation, referring to funds that are substantially invested in traded securities while charging private equity level fees, that becomes a problem. The exodus has begun, and history suggests that once confidence breaks in leveraged illiquid strategies marketed to unsophisticated investors, the unraveling accelerates rather than stabilizes.